If you're planning for retirement as a couple, here's a simple question with huge tax implications. Are both of you retiring in the same tax bracket, or will one of you carry most of the income? Because if you've built up most of the retirement savings under one spouse's name, could be heading for a massive tax surprise. Luckily, there's a powerful strategy to help fix this, but most Canadians either don't use it or use it too late. It's called a Spousal RRSP, and when used properly, it can help couples reduce their lifetime tax bill, create more flexibility on income in retirement, and keep more benefits like old age security. Hi there, I'm David Drummond, founding partner at DLD Financial Group, and I help Canadians retire with clarity and confidence using tax smart strategies most people never even hear about from traditional institutions. And if you and your spouse are planning for retirement and want to avoid the tax traps that can come from uneven income, this video is for you. And if you find it helpful, make sure to like, comment, and subscribe. Let's break it down. Part 1. Well, what is a spousal RRSP? Let's start with the basics, because there's a lot of confusion around how a spousal RRSP actually works. A spousal RRSP is just like a regular RRSP with one key difference. The contributing spouse, usually the higher earner, puts money into the account, but the receiving spouse, which is usually the lower income earner, is the legal owner of that account. The contributor still gets the full tax deduction for that contribution in the year it's made, just like they contributed to their own RRSP. When the money is withdrawn in retirement, it's taxed in the hands of the spouse who owns the account, which is usually the one in the lower tax bracket. That's the real value. It's not about saving more, it's about splitting income across both spouses to reduce the overall household tax bill. Let's put this into a simple example. Jamie earns $140,000 per annum and expects to retire with a large RRSP. Their spouse, Alex, earns part-time income and hasn't been able to build much savings. If Jamie contributes $10,000 to a spousal RRSP for Alex, they'll get the deduction against their $140,000 income now, and in retirement, the withdrawals from that account will be taxed in Alex's hands, likely at a much lower rate. The government only taxes individuals, not couples. So if one person ends up with all of the retirement income, you can miss out on half of your tax brackets. A spousal RRSP is one of the most powerful ways to fix that imbalance. Part 2. Why income splitting matters in retirement. Now let's go deeper into why this actually matters. Canada has a progressive tax system, which means the more income you make, the higher your marginal tax rate. And even a $5,000 to $10,000 difference in income can push you into the next tax bracket. That might not matter much during your working years when each spouse has a relatively stable income, but in retirement, things shift. Many couples find themselves in one of two positions. One spouse has saved the majority of the retirement assets, usually the one with the higher career earnings, and the other spouse has little in RRSPs, no pension, and minimal CPP or OAS because they work part-time, stayed home with kids, or earn less over time. So what happens in retirement? The higher earning spouse is now drawing $60,000 to $90,000 from RRSPs, corporate income, or pensions, while the lower income spouse has maybe $10,000 to $15,000 in income, if that. And here's the problem. The higher income spouse is now in a 30 to 40% marginal tax rate, while the lower income spouse is being taxed at say 15% or less, with unused credits going to waste, and your household is effectively paying thousands more in tax than you need to. Not to mention, if the higher income spouse crosses the OAS clawback threshold, which is around $90,000, they start losing government benefits as well. By splitting income across both spouses, you can keep both people in lower brackets, reduce or avoid OAS clawback, and create more net income from the same portfolio. That's why tax smart couples don't just ask, how much will I have in retirement? They ask, who will it be taxed on and at what rate? That's where the spousal RRSP becomes such a powerful planning tool, especially when used early enough to build balance between both partners. Part 3. Who should consider a spousal RRSP? So who actually benefits most from a spousal RRSP? The short answer is any couple where one person earns significantly more than the other, both now and in retirement. But let's break it down a little bit further with some practical examples. Situation 1, the career and balance couple. Let's say one spouse is a lawyer earning $200,000 per annum. The other has worked part-time over the years and earns approximately $40,000 per annum. In this case, the higher income spouse will likely max out on their own RRSP soon, and the lower income spouse won't have as much contribution room or assets to build up. And by the time they retire, most of the savings will be in one person's name. That is a textbook example of when a spousal RRSP makes sense. The higher earner can keep contributing and getting the deduction while gradually building a second retirement income stream in the lower income spouse's hands. That could save tens of thousands of dollars over the course of a retirement. Situation 2, the business owner couple. This is a big one we see often. Let's say you're a business owner or an incorporated professional. You pay yourself through salary or dividends, and your spouse isn't part of the business. Over time, you've built up a large RSP, a corporate account with retained earnings, and maybe even some real estate or non-registered investments. Meanwhile, your spouse has very little in registered accounts. If you do nothing, that imbalance will result in most of the retirement income being taxed in your name. A spousal RSP gives you the ability to shift future taxable income to your spouse, balance out withdrawals later, and avoid triggering higher tax brackets or OAS clawbacks. This is especially important if you plan to retire early before age 65 when pension income splitting doesn't yet apply. Situation 3, the one-sided saver. Maybe you're both working professionals, but one spouse has always been more focused on savings. They've maxed out their RSP each year, invested aggressively, and built up some real wealth. Meanwhile, the other spouse has a pension but hasn't saved much outside of that. In this case, a spousal RSP allows you to redistribute assets gradually and reduce the risk of uneven retirement income. Because here's the thing, it's not just about fairness or balance, it's about minimizing lifetime tax across both individuals and making your total retirement income more efficient. Ideal candidates for spousal RSPs typically have a significant income gap between spouses during working years or projected in retirement, a desire to reduce future tax and optimize retirement income, a long enough lifetime before retirement to let the strategy work, and RSP contribution room available under the higher income spouse's name. This strategy works best 5 to 10 years before retirement when there's still time to build up that balance over time. But what if you're already closer to retirement? Well, you can still use a spousal RSP, but you need to watch for the 3-year attribution rule. If your spouse pulls money from the account within 3 years of your last contribution, the income gets taxed back in your name, which defeats the purpose. So if you're already close to retirement and don't have time to wait out those 3 years, you may need to focus on other income splitting tools like pension income splitting at age 65. That's why timing is everything with a spousal RSP. If you're in your 40s or early 50s and there's a noticeable imbalance between your and your spouse's retirement savings, this is your window. Part 4, how to use a spousal RSP effectively. A few key rules to know. Number 1, the contributor claims the tax deduction. Even though the account is in the lower income spouse's name, the higher income spouse gets the tax deduction in the year of contribution. Number 2, the withdrawals are taxed in the hands of the annuitant spouse, as long as they're not withdrawn within 3 years of the contribution. This is called the attribution rule, and it's important. If you contribute to a spousal RSP and your spouse pulls the money out the same year or within the next 2 years, that withdrawal will be taxed back in your hands. So this is not a short-term tax play. It's a long-term income splitting strategy best used when you have a few years to plan ahead. Part 5, spousal RSP versus pension income splitting. Now you might be thinking, can't I just use the pension income splitting in retirement instead? Well, yes, but there are key differences. Pension income splitting allows couples to shift up to 50% of eligible pension income to a spouse on their tax return, but it only applies after age 65 unless you have a defined benefit pension. It doesn't work for RSP withdrawals before that age, and it doesn't allow for custom contribution planning beforehand. A spousal RSP, on the other hand, works at any age, lets you build a more balanced asset base over time, and gives you control over how much income each spouse receives. They don't compete, they complement each other. If you can use both tools together, you create a much more tax-efficient income strategy in retirement. Part 6, coordinating with other accounts, RRIFs, TFSAs, and corporate assets. Here's where great planning becomes essential. Spousal RSPs are powerful, but they're only one part of the bigger income puzzle. In retirement, you may also have RRIF withdrawals, TFSA income, OAS, CPP income, dividends from a corporation, non-registered investment savings income, and each of these has a different tax treatment. The timing of the withdrawals can impact your total tax bill significantly. So the goal isn't just to open a spousal RSP, the goal is to coordinate all of your accounts into one clear, sustainable plan where income is balanced, taxes are minimized, and you always know what's coming in the door. So should you use a spousal RSP? If there's a big income gap between spouses now or in retirement, want to reduce taxes and improve flexibility, and if you have time to plan ahead, then yes, a spousal RSP can be one of the smartest retirement planning tools available to Canadian couples, but it has to be used strategically, not just as an afterthought. If you're not sure how spousal RSP fits into your plan or how to coordinate with everything else like a TFSA or RRIF and corporate assets, let's talk. At DLD Financial, we help high-income Canadians build retirement income plans that are clear, tax-efficient, and designed to last. Book your free retirement call using the link below, and we'll walk you through exactly how to reduce your tax bill as a couple and make the most of your retirement savings together. Thanks again for watching, and don't forget to like, comment, and subscribe for more expert retirement content made for Canadians just like you. We'll see you in the next video.